doesn't show it. Okay, hopefully now everything should be live. So if it is, we should be all good. I can't check it right now. It looks like the conference is now starting now, so that's at least good timing in that front. Yeah, now we're live. Don't know what issue YouTube was having. So sorry for that delay. We have been trying to go live since about 9:25.
Final panel of our conference. Inflation is lingering.
So again, we're just going to leave the speech basically live. We'll chime in when we need to, but really we're just trying to let this run out.
Or raise rates. Even the Bank of Japan is considering unraveling its decades-long ultra-loose monetary policy. The question now is how long will policies have to stay in restrictive territory to bring inflation back to institutions' 2% goals? And is it possible to do so without creating a recession? Ladies and gentlemen, the members of our next panel will bear a great deal of responsibility for bringing inflation back down to 2, and not only that, but keeping it there. Sarah Eisen, the closing bell anchor at CNBC, will be moderating this session. Sarah, over to you.
Thank you so much, Claire. And let me just say, as a business and financial journalist who started out in foreign exchange, this is pretty much as good as it gets. So thank you for having me talking to the Big Four today. And what I love, I'm excited for this conversation because it's always fun when everybody's in different places and going at different speeds and maybe disagreeing, if you dare to do so today. So thank you all. President Lagarde, I'll start with you as the host of this meeting. On The View from Europe, I'm curious where all of you are in terms of this policy path. We've certainly seen a fight against inflation. You've been very clear that there's more work to do. How much more?
Thank you so much, Sarah. It's very nice having you in this closing moment. And I'll take this opportunity to thank all the contributors, those who have prepared papers, those who have worked with the presenters, and all the panel members.
Just as a heads up, we'll want to know out on CL.
Thank you. So, as far as
is there a way to pin this to the top?
And the Eurosystem at large, we have covered a lot of ground. We have increased.
I don't think there is.
Our interest rates by
but anyway, CL. So Colgate does have a key support coming down at $74.47. The alert just went off, so if we do come down to their potential long off that level.
We will decide on a meeting-by-meeting basis, but we know that we have ground to cover, and if our baseline stands, then we also know that we will very likely hike again in July.
What about September?
That I will not tell you, and for a very simple reason that I just mentioned, we are data dependent.
So again, the key thing, likely to already hike in July.
I'll tell you, for the September meeting, we will have received a lot more data.
Again, don't forget these are European markets, ECB, so if you want to be looking at it from a US perspective, probably looking at the currencies will be the way.
So we will have a lot in our hands to make our decision then.
Governor Bailey, you
6E will be the euro, by the way, for the ECB.
Raising interest rates by 50. You did a double. Why did you feel the need to do that?
Well, it really picks up on the theme that Christine has just developed. First of all, I mean, the UK economy has turned out to be much more resilient, and that's a good thing. I mean, there's many good aspects to that, but what goes with that resilience is signs of a very tight labour market, which is showing through in pay awards, but also showing through. I mean, we've got an unemployment rate of 3.8%, which is historically right at the low end. So that resilience is coming through that way. But when we looked at again, to Christine's point, when we looked at the data, because we too are being driven by evidence at the moment, the cumulative data, both particularly on the labour market and on the inflation release we had, which to us showed clear signs of persistence, caused us to conclude that we had to make really quite a strong move at that point. It was justified. My own view on that was, if we were really of the view that we were going to do 25 and then we were really sort of baked in for another 25 based on the evidence we'd seen, it was better to do the 50. And then we will as Christine said, we will be evidence-driven, so we will wait for the next set of evidence for our next meeting, which, to Christine's point again, will also be one where we will have a full forecast.
Have you received a lot of flack for the move?
Well, I think at the moment I can understand why there are critics of us and central banks. We have a job to do. I'm very clear that our job, all of us are very clear, I think our job is to return inflation to target, and we will do what is necessary. I understand the concerns that go with that, but I'm afraid I always have to say that it is a worse outcome if we don't get inflation back to target.
Something I know you've all been saying. Chair Powell, you've said it many times, and yet you paused, but you're not calling it a pause, and you're not calling it a skip. So what are we calling it?
Well, first of all, Sarah, thank you, and Christine, thanks for hosting us here in Sintra. So what we're calling it is maintaining the level of the federal funds rate at its current level for this meeting. Thank you.
Good to see if this bar starts reacting once Jerome Powell speaks.
If you think about it, we've raised the federal funds rate by 500 basis points since a little more than a year ago, and we think so we've come a long way. We also think that there's more tightening power coming through. Really, policy hasn't been restrictive for very long. We started at negative real interest rates, and we've now moved up to where we actually are in restrictive territory, but we haven't been there very long. So we believe there's more restriction coming. And what's really driving it, to Andrew's point and Christine's as well, is very strong labor market. We've got a labor market that, where jobs are being created, there's strong wage gains, and that's driving spending, driving real incomes and driving spending, which is driving more demand and continuing to drive labor market. So the labor market is really pulling the economy. And my colleagues and I, as you will know, wrote down in our SEP 2 more additional rate hikes. The median was quite a strong majority, actually wanted 2 or more rate hikes. And the reason for that was, if you look at the data over the last quarter, what you see is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation. So that tells us that although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
So I don't get why you didn't raise rates at the last meeting, especially I think it was a surprise that it was a unanimous decision to hold rates steady when you said a majority think that they still need to go farther on raising rates.
It's really just as you get closer and closer to the goal. What we're aiming for is a stance of policy that's sufficiently restrictive to bring inflation down to 2% over time. As you get closer to that, you get closer to the place where the risks become more in balance. So, we did 4 75 basis point hikes in a row starting in June of last year. In December, we moved down to 50. Then we did 3 consecutive 25 basis point hikes. So this is really just a continuation. We're going to move the decisions a little bit, make them with a little bit more time in between them, in an effort to get more information from the data to see how much restraint is really coming from these, through the pipeline, from rate hikes that we only made now, in many cases, 6, 8, 9 months ago. So that's why we did it.
So maybe in every other meeting hike.
We've not decided that. So the only thing we decided was not to raise rates at the June meeting. We have not made a decision to go to that. It may work out that way. It may not work out that way. But I wouldn't take moving at consecutive meetings off the table at all.
I'm trying. Governor Ueda, first of all, it's great to talk to you. We haven't heard much from you outside of your policy meetings in Japan. I think the world wants to know why you're the global outlier here. You have decided to maintain your easier monetary policy in the face of rising inflation. Why?
So a simple answer would be, although the headline rate of inflation is above 3%, which is well above the 2% inflation target, we think underlying inflation is still a bit lower than 2%. That's why we are keeping policy unchanged at the moment.
Even though we've seen measures, including core, right, higher than the 2% level.
Yeah, the usual core is also above 2%. But let's say, let's look at the rate of increase in wages, which is an important determinant of underlying inflation. It has risen, but is now running at around 2%. Now, if you want a 2% inflation rate, wage inflation that's consistent with that would be slightly or well above 2% if you assume productivity growth rate is positive. So there's still some distance to go, we think.
And as a result of your policy being different than all these policies of your colleagues, the yen has gotten very weak and continues to weaken by the minute. Is it too weak?
Well, the yen is being influenced by many factors other than our monetary policy, including the policies of these three banks. So we'll see. We monitor the situation very carefully.
Monitoring the situation?
Yes.
For intervention purposes?
No, it's the jurisdiction of the Ministry of Finance. Decisions on intervention.
President Lagarde, how much would you like to see inflation moderate from these levels? Because we've already seen a nice moderation for you to feel comfortable taking a pause or potentially going the other way.
Well, this is not what we're considering at the moment, okay? But if I look back at what we've covered, inflation was, I think the highest reading we had was 10.3. We are now at 6.1 headline. Core has moved a bit down, but we are really looking at both headlines, which is the measurement that we have agreed in our strategy and that is visible for people, for the consumers of Europe, but we're also looking at underlying inflation. And on that front, you know, we are not seeing enough tangible evidence of the fact that underlying inflation, particularly the domestic prices, are stabilizing and moving down. So we're looking at as many measurements as we can because we want to be in sufficiently restrictive territory for long enough so that we are confident that we reach our 2% medium-term target.
Why is it so sticky, Governor Bailey? And why is
By the
your
way, I am
inflation
noting
rate
down all
higher
the key
than
things.
that
We'll
of
run through
Europe?
these in a bit and see what should affect the market.
So, with headline inflation, I do expect it to come down markedly this year, as we've been expecting for some time. And a lot of that is to do with the fact that the unwind of energy measures in the UK is on a sort of somewhat longer track, so that we will see some quite sort of discrete sort of jumps down in headline inflation in the UK throughout the rest of this year. And indeed, actually, you know, energy prices are now somewhat weaker anyway than we thought they would be even quite recently. So it's core that's the issue, just as Christine has said. Core is much stickier. I think I come back to the labour market again. We have a very, very robust labour market and strong labour market in the UK. One of the striking things about the UK is that the size of the labour force is smaller than it was at the outbreak of COVID. So we have had a shrinkage of the labour force. We're seeing some reversal of that now, but we're still not back to where we were pre-COVID. So that is causing you know, the position in the labour market to be very tight. And I see this when I go around the country talking to firms, because I can, you know, what they say to me very frequently is that their plan is to retain labour as much as they can, even in the event of a downturn, because they've been concerned and it's been difficult to recruit labour. So that's certainly taking place. So
Also, the ENVX trade's coming down. It's pulling back. It's coming near to that entry, so we should be up if we can continue to pull down. Potentially look to reposition a bit at 1563 for the 2-day anchored VWAP.
You know, the response to COVID. I mean, we've seen people. UK is a little unusual in this respect. We saw people come out of the labour force during the COVID period. Other countries have tended to see that position reverse more quickly and more strongly than we've seen in the UK.
Governor Ueda, when it comes to the inflation path for you, I mean, I know you'd like to see it continue to rise from here, right? What would it take for you to really strongly consider abandoning the yield curve control and negative rates?
So we have a forecast or a projection of inflation path that looks like it's going to go down for a while toward the end of this year on declines in import prices, and it's spilled over to domestic prices. And from there on, we are forecasting some increase in the rate of inflation into 24. But we are less confident about the second part. If we get if we become reasonably sure that the second part is going to happen, that could be a good reason for a policy change.
If you see a steady increase.
If we are reasonably sure that the second part of the forecast is going to
But didn't
materialize.
you learn
Meds
from
cracking down as well,
history
down
that
at $13.
Inflation turned out to be not transitory?
Excuse me?
I mean, wasn't one of the lessons from the last year that inflation wasn't transitory and that there are some
Was
elements
not.
in it, was not?
Yeah.
And that there are some elements of it that are sticking and proving difficult to fight.
Right. So the second part is the sticky part, but it's still, as I said, we think less than 2%. We hope to make sure that it's going to go up to 2%.
Chair Powell, we've seen some progress in the US. Certainly, if you look at the headline CPI from 9% down to 4%, I know you're focused on core, but what would make you feel better about it that you could remain on hold?
So the progress on headline inflation coming down is certainly welcome and ought to help keep inflation expectations anchored. But I think it actually helps to think about core inflation broken into three pieces. The first of which is goods inflation. And we've seen goods inflation coming down for 6 months now. And that's because supply chains are improving, the shortages are more or less gone, and also because consumption is moving back to services and away from goods. So that part of the story makes sense. Housing services is the next piece, and between that and goods, you have a little bit less than half of the total index. And you see now the new rents that are coming in are at lower increases or no increase, and so there's significant disinflation in the pipeline there, but it's going to take 12 months or 18 months to get there. The place where we haven't really seen much progress is in non-housing services, which is a little more than half of our core PCE inflation index, and that's hotel services, travel services, food service, financial services, healthcare, those things. It's generally very labor intensive. Some of it's quite cyclically sensitive, but some of it's not. The point is, that's where we're not seeing a lot of progress yet, and the reason is that, or one explanation for it is that labor costs are really the biggest factor by far in most parts of that sector, and so what we need to see, we've seen a lot of signs of softening in the labor market, but it's just kind of beginning. We need to see a better alignment of supply and demand in the labor market and see some more softening in labor market conditions so that inflationary pressures in that sector can also begin to subside.
Are you surprised that hasn't happened yet after 500 basis points of tightening already in a little over a year?
Yes, I think widely it's been surprising that inflation has been this persistent, but I think the bottom line is that policy hasn't been restrictive enough for long enough to start to see those effects. And the service sector is not especially interest rate sensitive, by the way, as opposed to, for example, the goods sector. So we wouldn't expect it to be the first to be affected, but we would ultimately expect, as demand softens and as labor market conditions go more into balance between supply and demand, we would expect to see inflationary pressures subside in that sector as well.
Do you guys coordinate? Do you talk amongst yourselves?
Yeah, of course we do.
I mean, do you call before policy meetings?
Can I
Yeah,
just,
please.
I just want to follow up on what Jay said, because I think he's completely right. And I think that this is what I call the catch-22 issue, where we have an expected catch down where manufacturing eventually will align, or services will align on manufacturing, and that would be the logical consequence of the lag time that it takes for services to align with manufacturing and to, see prices go down in that sector. The catch up is that of labor, because it is, as Jay said, labor intensive. It's generally relatively low productivity and low skilled jobs in those sectors, and also those jobs that are going to seek the catching up with pre-COVID times. And how that catch down, catch up will be resolved is going to be critically important for where inflation is heading. Because if we see inflation going down in that service sector and movement of wages,
as a heads
while
up, the
increasing
ENVX
at a
trade is
moderate
basically gone to
pace, then we
break
would be
even.
in a
Just checking it
relatively
out
good
now.
place. But that is
Even though we're not
totally
even at the
a
break
question
even
mark
price,
at
so the
moment.
calls
Yeah, it
premiums
sort
are
of raises
definitely
the question, Chair
outperforming.
Powell, about whether we need to see a much higher unemployment rate in the US, and you're all dealing with a tight labor market, to finally really break inflation?
So, you know, that the way we think about that is that there seems to be a path still for labor market conditions to soften and for demand and supply to get back into balance without the kind of large job losses that have happened in many prior cycles. And the reason for that is the level of job openings that still exist in the labor market. So it's still set 1.7 job openings for every person who counts as unemployed. That has been coming down. It's come, actually the number of job openings has come down now by almost 2 million. And what you're seeing is, wage pressures. They're still high, but they're definitely coming down. You're seeing surveys of workers and businesses suggest that the labor market is not as tight as it was a year or two ago. So you're seeing a job creation is beginning to come down. There are a number of indicia that would suggest that we're getting the softening that we need. We're getting it slower than we'd expected, but nonetheless it's happening. So it's still a possibility there. But you know, it's so uncertain right now that in my view, the least unlikely case is that we do find our way to better balance without a really severe downturn. I think there's a significant probability that there will be a downturn as well, though, but it's not to me the most likely case.
That's the hard landing scenario.
Or just this, I wasn't even thinking of hard landing. I was thinking of even a recession. To me, it's not the most likely case, but it's certainly possible. And of course, many forecasters do predict that.
Is Europe in recession, President Lagarde? I mean, we've seen 2 negative quarters of GDP. I don't know how you define it. But
this could be key if he says yes, or she says yes.
Completely flat, wasn't negative. So technically, I think you could argue that we did not see a recession, but it's stagnant, to say the least. And the expectations for Q2, particularly in the industrial sector, if I look at PMI numbers, are not particularly are not giving us great hope that there will be a strong recovery. We see a second half of 23 up from the first half, certainly, but moderate. We have a 0.9 forecast for the whole year.
Do you agree with Chair Powell? Do you think you can get away with this tightening cycle without dragging Europe into recession?
Our baseline does not include a recession, but it's part of the risk out there.
Are you willing to tolerate a recession?
Well, the interesting thing for us is that if you go back to last November, when we did a forecast, we were predicting quite a long but quite shallow recession. And the economy, as I said earlier, has turned out to be much more resilient so far. Now, I think you can sort of point to a number of things that underlie that. One of the things I would point to is the fact that we've had a very sharp fall in energy prices in Europe. And that obviously has helped with the whole question of the terms of trade.
The euro is basically back to flat before the speech, and EMVX is still pulling back.
Trade shock, and that feeds through into national income. So I'm not surprised that we've had this reversal in one sense. What was surprising, but actually very helpful, was that, of course,
just at 10 a.m.
big fall in energy prices and a much better winter, frankly, than we thought we would have. So, yeah, we're going through this year now in a more resilient position than I expected. So we're not currently forecasting it, but obviously we have to watch it very carefully.
How's the Japanese economy faring? I mean, it's very exciting if you look at the Japanese stock market at a 30-decade high. What's happening fundamentally?
It's doing fairly well. I mean, apart from the contribution from some inventory investment, domestic economy is expanding at a pace slightly above potential, I think, driven by pent-up demand. We relaxed pandemic-related restrictions in May, and this is stimulating consumption and investment. There's also green GX, DX-related business fixed investment taking place. So investment is fairly strong at the moment. We think the economy is going to expand at slightly above potential for some time. But there's, of course, a lot of uncertainties going forward, including what may happen in Europe and the United States.
I asked if you guys coordinated or talked about monetary policy before. I mean, does that happen? Should it be more coordinated? Because you're all doing different things right now.
Well, I mean, if I start, I mean, obviously what we don't do is say, what shall we do, what shall you do, because we're all setting monetary policy for our areas, and that's the law in all of our areas, actually, so we don't do that. But we do talk a lot, and I think it's important. I mean, it's important at all times, but it's particularly important in recent times at the moment because we're facing such big global shocks. We've got common shocks. They differ a little bit in terms of their impact and their effect, but there's some huge global events going on that are affecting all of us. So, I think we do talk quite a lot and we see each other quite a bit because it's important we do that. And, we share wisdom on how we're sort of interpreting the things that are going on around us.
Yep. I guess we are in a flexible exchange rate world, so we do policies independently. But of course, we exchange information, which is very, very valuable.
Do you think that, Governor Ueda, do you think that they are over-tightening?
No.
No, you don't. You approve of the policy. You've had a very tight labor market for a long time in Japan, even before COVID.
Yes.
Demographic issues
demographics
there, yeah.
is working in a way to tighten the labor market for quite a long while. And it's going to continue this way for a while.
I mean, the economic conversation, it gets into an interesting question, Chair Powell, where now we're wondering, easier to fight inflation last year when the economy was doing better, but now that we're seeing signs of softness and weakness in manufacturing, and you mentioned the labor market starting to cool off, about overdoing it and the risk of overdoing it. Do you wonder about that, or you're still just focused on inflation?
Let me say the U.S. economy has actually been quite resilient, and the data that we're still seeing, including since the last meeting, still is consistent with with an economy that's resilient and growing albeit at a modest pace. As I mentioned earlier, though, yes, there was no question. The first question was how fast should we go, and we went pretty fast, and we got to a level that we believe is restrictive. We're in restrictive territory. If you take the federal funds rate and you subtract some forward-looking measure of expected inflation, you'll get a significantly positive real rate, meaning we're probably in restrictive territory. So, and I think we have steadily slowed the pace of our moves, and it's appropriate to do so for one reason, because the more information we get, the better decisions we'll make. The risks of doing too much versus doing too little become more in balance. I wouldn't say they're in balance yet, but they're becoming closer to balance. I still believe and the committee clearly believes that there's more work to do, that there are more rate hikes that are likely to be appropriate, though.
So you think the risk is still of doing too little and not getting control of inflation?
Yes, and of course
But inflation expectations are, I don't have to tell you, very well anchored.
No, but the thing with the risks is that there may be social costs associated with restoring price stability. The social costs of failing to restore price stability will be higher in almost all likely cases. We've seen what that looks like, and it's just something that we have to do. It's one of the principal things that society counts on us to accomplish, and I think we all feel committed to accomplishing it. It is of course a good thing that inflation expectations have remained anchored all this time, but our understanding of inflation expectations is not a precise one, and the longer inflation remains high, the more risk there is that inflation will become entrenched in the economy. So we have to, the passage of time is not our friend here.
What about a higher inflation target? I know none of you want to talk about that, but on Wall Street, there's this idea that a lot of things are changing in our economy structurally. The onshoring of supply chains and chip plants and all of that is going to be expensive and could permanently create higher inflation rates. Couldn't it, President Lagarde?
Well, at this point in time, and given the fight that we lead against inflation, the yardsticks that there is, the strategy that we've agreed, the expectations that we have, and the inflation targeting as it has been said, there is no way that any of us, I think, would consider changing.
Nerve could be a nice potential long at this 875. I'm going to watch it out.
Or more than halfway through that journey. I think it's wonderful to have a forum like Sintra, which brings together academics and other than policymakers to actually consider those ideas and to explore them and to weigh the cost and benefit and all the rest of it. But at this point in time, I think we have to be as persistent as inflation is persistent, and we have to be resolute and decided and determined in reaching the target that we have set, and not debate the target as we are running that race.
But it does raise the question, Governor Bailey, about how far inflation will come down to.
It does, but let me reinforce what Christine said. What is the inflation target? It is the definition and practice of price stability. You know, in our legislation, it is what price stability is taken to be. That is the 2% target. And I don't think anything has changed in terms of what we mean by price stability. And I think that's a very important point to start with. It's the anchor that we have to always maintain. Now, in terms of bringing it down, yes, I mean, we're facing, have faced and are facing, the biggest challenge for a very long time. But we have to meet that challenge. I don't think it is the right thing to do to say, well, this is all a bit difficult, let's change the target. I really don't think that is the right thing to do. I think that would be a very bad thing to do. And I think, although I very much agree, as Christine was saying, that there are things we understand about inflation expectations and things we don't understand about inflation expectations. I think taking risks of that nature with inflation expectations, but also fundamentally changing what we mean by price stability when there's no good reason to do that, I think would just be the wrong thing.
How do you read, Governor Ueda, the inflation expectations? Because they've crept up in Japan as well.
Yes. We've been for a long time trapped in a zero inflation expectations equilibrium. So we've been trying very hard to move this to a 2% inflation, 2% expectations equilibrium. To do so, we had to de-anchor expectations from zero, raise inflation expectations, and in the future, we'll have to re-anchor them at 2%. This is a formidable task, and now we are seeing signs that inflation expectations are rising. But as I said, not to the extent
there we go, looks like we're getting that bout.
in the 2% inflation expectations equilibrium.
It also raises the question, you mentioned the labor market and some of the post-COVID changes about just how COVID has distorted the data and has made travel, for instance, so strong for so long. And I wonder, Chair Powell, how you look at the COVID impact on the economy and how it's changed the way you make forecasts and you think about what's happening right now.
Well, I think there are changes, and we don't know how persistent they will be. Certainly work from home, and you can see the effect on commercial real estate, particularly office real estate and the surrounding retail that it's suffering in many major cities. We don't know how long that will last. It feels like some part of that will be persistent and will last. You mentioned the data as well. I guess response rates to a lot of the data that we collect and the other organizations collect, the response rates have gone down, and you're seeing a lot of volatility in some of these data series, more so, I would say, more so than we've seen historically. So the data are even a little bit foggier than they usually are. But we'll be, in terms of what the effects of COVID, it's going to have long-term effects on the economy. There may be loss of productivity. There's certainly been, for a generation of kids, some loss of education and training. I think it's hard to say how persistent all this will be.
What is your level of concern of commercial real estate, since you mentioned it in the U.S.?
It's something that we, of course, are watching carefully. The way it lays out is the large banks don't have large concentrations of commercial real estate.
Also, crude oil inventories coming out in 20 minutes.
A surprisingly large part of exposure to commercial real estate is in the banks that are under 100 billion. But there, the worry is more banks that have a high concentration, and they're relatively few. So it's something that we're carefully monitoring. Bank supervision has a playbook for this. So supervisors are talking to banks about their concentration of real estate and what can they do and how do they manage themselves out of this. It's something that we're well aware of. It's not a surprise, and we're focusing on it.
Is it one of the reasons you were cautious in the last meeting?
Commercial real estate? I wouldn't say so. No, I just, generally speaking, it was, at the last meeting, it was about, what's in the pipeline, how far we've come, what's in the pipeline. I will also say that, though, that the bank stress that part of the decision, in my thinking anyway, was the bank stress that we experienced earlier this year. There's a fair amount of research showing that when something like that happens, bank credit availability and credit can move down a little bit with a bit of a lag. So we're watching carefully to see whether that does appear. Of course, tightening in financial conditions is what we're doing intentionally. So we have seen bank credit conditions tighten. The question is, and that's what we're trying to achieve. The question is there another channel of that or a greater amount of that coming from what happened in March? We don't really see any evidence of that, but I think that's certainly in the back of my mind to see whether we do see that.
Yeah, it gets into the question about lags. How long are lags, Governor Bailey? And do you expect to see more?
It's a very interesting question in terms of the transmission of our monetary policy decisions. So if I can just illustrate it with the UK case, and obviously it's not the only part of the transmission mechanism, let me be clear, but it's an important part, and illustrate it with the UK mortgage market. So we've seen a big structural change in the UK mortgage market since the last tightening cycle of monetary policy, which of course, accepting passage of time, was about 20 years ago actually. And that change has been a change from a variable rate mortgage market to a fixed rate mortgage market. Now, I must say, obviously with Jay here, it's not a US style fixed rate mortgage market. It's a much shorter term. So the average term is often around 5 years. But we know, and we think around about 85% of the stock of UK mortgages are now sort of in that part of the market. So we know that the transmission of monetary policy is going to be slower as a result, because obviously it depends upon the sort of the timing and the sequence of those fixed terms coming to an end often. So we have to judge that. I mean, it's another factor and another sort of element of uncertainty that we have to judge when we're taking our decisions, which is how much of the tightening that we've already done has come through and how much is yet to come through. And we know that referring back quite a way into the past isn't going to help us in that respect. So we have to sort of formulate those views afresh. And so it is part of our decision-making calculus is how much more has to come through, when will it come through, and also how powerfully will it come through. And all those things are things we have to take into consideration. And as I said, history isn't going to be a great guide for that, given the change in the market.
So a year? What's a lag?
Well, what you see, and of course you can compute, is the sort of the profile of mortgages coming up for renewal, renewed terms, and we can see that over the next year or so, there's quite a lot of fixed rate mortgages are coming up for renewal. So yeah, we can factor that in. There is another.
The nerve trade's moving really nice. I ended up getting out the rest of the position at 8.99 because that was when my stop loss come. Faked me out and now obviously popped, but either way the plan was still good.
The first one is transmission in terms of tightening of the financing terms that are made available and how markets absorb the decisions that we make. And on that front, we have a good and reasonably rapid transmission. We see it in rates, we see it in volume of loans, and on both accounts there is a good absorption and a rapid transmission of our monetary policy decision. But that's only step one. What we need to see is step two and how it materializes on investment by corporate, and for households it's predominantly mortgages. And for the euro area, there is a lot of heterogeneity, because you have markets where mortgages are at fixed rate, markets where mortgages are at floating rates, some that are readjusted every so many years. So we have to look at all those data very carefully, but it seems that the transmission is likely to be less rapid than it had been in the past, because there are many more fixed rate mortgages now in the euro area than there was, say, 15 years ago. And that's not it. We need to see it then channeled to the third step, which is inflation. So we want to see that transmission strength through step one, step two, step three, and make sure that this is really having an impact in terms of the fight we have against inflation.
Governor Ueda, do you worry about the impacts, the lagged impacts of their policies on the global economy and on your economy?
Oh yes, but for ourselves, we haven't had any serious monetary tightening for 3 decades. I was a board member of the BOJ 25 years ago. Then the policy rate was about 20, 30 basis points.
Wow.
Now, minus 10 basis points. So,
And it doesn't sound like it's changing anytime soon.
so in terms of that, the lag in the effects
Next
of
opportunity I'm looking at on
monetary
nerve
policy
is if we can
25
break the
years.
$10. We've got level at 11.66.
We'll see what will happen if we get to normalize policy seriously, but we'll have to be very careful here.
Be careful what you wish for, I guess. So, Chair Powell, are you more worried about the lag impacts than they are because they're still hiking rates?
I don't know. I wouldn't want to compare. I would just say again, so what's different this time is actually, though, that markets move substantially in anticipation of moves. So by the time we lifted off in March of 2022, the 2-year had moved from 20 basis points up to 200 basis points. So financial conditions now move in expectation, and the whole modern communication strategy really helps that along. So that is different. What may or may not be different, and we also haven't had this kind of tightening in 3 decades, really. We've had tightening, but this looks more like tightening cycles from the 70s and 80s. So what we see is a picture of literature that has, the older literature says, a year or 2 for activity and add a year for inflation. There's new literature that says it's much faster than that, and I think we just have to use our, to watch and see what's happening. There are beginning to be, there are reasons to argue that it would be faster this time or slower this time, but I just don't think we know at this stage.
Well, it kind of gets into the question about the markets, and
We're not really hitting anything new news, so in a sec we might just run through then the key things that have been said so far, and then we can let it play out, but it doesn't seem like anything else key is going to be said.
maybe one more hike in July and then done, and then into cuts next year. Is that wrong, President Lagarde?
I look at the data we have, I look at the mandate we have, I look at the transmission lag, and we've decided for ourselves that we would use 3 criteria. That's what we are focused on. Of course, we are not completely oblivious to what happens in markets, but we have to be guided by what the mandate is, what the data delivers, and what criteria we take into account in order to determine our policy and to establish our stance going forward. That's the only way to go.
But I guess, there's financial conditions, and I don't know, Governor Bailey, are they working against you? You're trying to fight inflation, and MSCI World is up nicely this year.
Well, by the way, the market, I don't think thinks we're nearly done at the moment. They've got a number of further increases.
We're testing the supports on nerve. If we can hold, then the 1160 move is quite likely.
Earlier, we're essentially evidence-driven in that sense. So,
Governor squeezing shorts today. Let me open up the chart. We'll run through it real quick.
I think you're right to point out, as you said earlier, and I would draw this point out, that there are 2 parts to this. There's where the peak is and then how long it's sustained beyond that. And I think both of those are relevant. Both of those are things that will, sorry to state the blindingly obvious, will emerge with time. But I've always been interested that the market thinks that the peak will be quite short-lived in a world where we're dealing with more persistent inflation.
Right. They did finally price out the cuts in the U.S. a few weeks ago. Market was primed for cuts. I assume you were pleased to see that that's no longer the case.
So if you go back and look at forecasts from the participants on my committee on inflation, you'll see, we've been consistently thinking this is going to take some time. It's going to be a process that will take longer than we would have hoped. And it may well be a bumpy process. But markets have gone back.
As soon as Jerome stops, we'll go through the Kavana for you, Justin.
Pretty quick declines in inflation to coming back to being more in alignment with the thinking of the committee. And that's where we are right now, is closer to where committee participants are. But as Christine said, we're not focused on what the market's forecast is. We have our forecast. All of us who are on the committee, we work hard to develop an understanding of what's driving inflation and what the path forward for inflation is. We make our best estimates. And that still is that it's going to take some time. It's just going to take some time. Inflation has proven to be more persistent than we expected, not less. And of course, if that day comes when that turns around, that'll be great. But we don't expect that. We don't plan for it.
So is it counterproductive to you that the stock market has rallied, the bond market has rallied? I mean, the market is fighting the Fed. The market thinks you're closer to the end, and I mean, that does make financial conditions easier.
Wasn't that the...
You can't fight the Fed, but they're fighting the Fed. Is that a problem for
I
you?
don't see it that way. I don't look at it that way at all. Honestly, we have different jobs. You know, our job is to bring inflation down to 2% and sustain maximum employment. That's our job. That's what we think about. We look at the data, and that's what we care about. And markets react, different parts of the market react in different ways. It's just not something that is a principal focus of our work.
But it did seem last year like you wanted a weaker stock market. You used the word pain at Jackson Hole. It seemed like you were trying to communicate that financial conditions should tighten, and less so this year. Is that right?
Not really, no.
Okay.
Of course, we work through financial conditions. That's what we do. Our rate and our, all the things we do and say work through financial conditions to affect the real economy. That's how it works. But it's broader financial conditions. So we're not focused on any one market. We're never thinking, oh, let's do this to this market. It's just, in general, let's communicate what we want to do and why we want to do it. And financial conditions adjust. And that's really all we can do. We do not target particular parts of the market, although, of course, we do monitor market conditions.
So you don't care what the stock market's doing?
I look at broader financial conditions. It's one of many, many conditions, along with interest rates, credit spreads, everything, all of the conditions and the availability of credit. It's one of many, many things. Again, we don't focus on any one thing as the key thing.
Governor Ueda, how important is it to you, the markets, as it relates to financial conditions and the mechanism for monetary policy?
You mean the stock market?
Stocks, bonds, currency.
So stock prices have been rising fairly sharply since spring this year.
Okay, we'll quickly run through the Kavanaugh now. Powell stopped speaking.
Theoretically, are affected
So quickly,
by
just to run through what I'm
interest
looking at
rates
on Kavanaugh.
and
For
investors'
you,
view of
Justin,
the economy.
is
We
we've got
haven't
support
changed
at
interest rates,
23.30.
so probably
So if we come down
investors
to
have
here,
become
that's what
more
I'm looking at.
optimistic
I'll
about
probably turn this down a tiny bit. If we push to the upside, then really looking at key resistances between that kind of 28.25 to around 28.50. And even if you think shorts are getting squeezed, I do think this is where you'll see a lot of shorting pressure, especially from algorithms. So that'll be the level I'm looking at, and we'll probably even look to trade it short bias myself. And if we did squeeze through that level, then we do have one higher level at 39.65, very far off. But if we did hit again another short bias level, so I hope that helps.
We all look at it, and we are all concerned about geopolitical development by virtue of the profession that we have, because it does have an impact on supply chain. It does have an impact on trade.
Crude oil release in 5 minutes as well.
The uncertainty, and we can only say that at this point in time, uncertainty is high overall, and a big factor of that uncertainty has to do with the geopolitical difficulties and conflict or quasi-conflicts that abound at the moment. So yes, we are looking at that, but do we have to make a moral judgment on this, that, or the other? This is not the job that we have, but it clearly has an impact on how the economy is going to change and be transformed, and whether it will have an impact that is inflationary or disinflationary, I think is also to be determined. I think there will be various schools of thought along those lines.
Yeah, I wonder how you think about next winter. I mean, Europe got lucky.
We hope it's mild.
What if it's not?
But storage is, what, 69%? Michael, the expert on Isabel's panel, said that 69%, and we are going to hit 95% by the end of the summer. So that should put us in a good position for the winter. But I'll say one thing, which probably we had not
Again, can link.
sufficiently.
This might move
Maybe
even
doesn't
the
apply to
release
all
in
of us. It's
4
the
minutes that bit
resilience
stronger.
of our economies, and the resilience of the entrepreneur, the corporates, the way in which we have sort of, in a matter of a few months, reorganized ourselves. just think 1 year back, everybody thought that the German model was dead, that Europe was going to be completely on its knees. Well, these things have not happened, and the resilience has been demonstrated at all levels of society.
I totally agree with Christine on this. That resilience, I mean, you see it when you talk to businesses. I spend a lot of time talking to businesses, and I've spent a lot of time in recent months talking to food-producing businesses to try to understand the sort of, the slower than, frankly, we expected decline in the rate of food inflation. And one of the things that I get quite consistently, and this is where sort of the Ukraine-Russia situation comes through for real, is they say, well, last year we brought forward our sort of supplies to a much greater extent than we would normally do because we were not confident we could actually get them. Consequences, we've locked in higher prices for, sometimes they say 6 months to me. And that, of course, is affecting the passage of inflation, particularly for food prices in this case. So these things do have a very direct effect and are continuing to have a very direct effect, actually.
But there's nothing central bankers can do about that, is there?
Well, I think the first thing we need to do is understand it. That's a good starting point. Well, we have to then design.
You can always just keep crushing demand, but you can't do anything about food supply.
Well, we have to design policy. I mean, we have to design policy and take our decisions with the best. We always take policy. We always take policy decisions on a forward-looking basis. So we have to do it with the best information and understanding we can get of these things.
So to what extent, I guess, is the war in Ukraine driving supply-side inflation for materials around the world?
Well, following on from what I was just saying, I think the conclusion I draw from that is, and this is what the businesses tell me, is yes, we are going to see actually a fall in the rate of food price inflation, for instance, but it is taking longer than we expected. So that's what we have to factor in and decide how best to, in a sense, to respond to that with monetary policy.
One thing I did want to note as well, as you can see here, we got the SPX straddle. When you're down below this VWAP, showing that the market's moving less than expected. So this speech has really moved the market less than expected.
Well, at least there's a tendency to relocate production sites out of, say, China into other Asian economies, including to some extent Japan. So in the short run, this is having a small positive effect on the Japanese economy through business fixed investment. But in the longer run, there will be inefficiencies all over the place. So we'll see.
So Japan's a beneficiary of the flight out of China?
In one sense and in the short run. But in the long run, I'm not sure.
I mean, Chair Powell, how do you think about, it's obviously a risk and it hurts trade. How do you think about the U.S.-China relationship as it impacts the economy?
So that is the way we think about it. Of course, we don't have any role to play in the relationships between the countries. But, China's a very large, important economy. It's a big trading partner, mainly consisted of us buying things that are made in China. I don't think, and of course, the Chinese economy came out of the COVID and looked like it was recovering strongly. Now it doesn't look like that. It looks like it's slowed down, and there's some issues there. From the U.S. standpoint, at the margin, that probably means a little bit less global demand. I wouldn't say it's a first-order consideration for us, though.
How does the Chair Powell reference the disappointing nature of the Chinese economy?
It already has just come out, by the way. That's why we're moving.
The global growth picture?
Well, first of all, I think we have to be attentive to the emerging market economies at large. At the moment, they are producing about 60% of global growth, some of which is now a bit more focused on domestic development and consumption, and less so on trade. But if you look at the trade volume numbers from China to
quite a big difference as well. We were forecasted negative 1.75 million, came out at minus 9.6 million. So quite a big difference. Obviously less supply than expected. So obviously going to move quite strong on the move. Would be looking at a target at 68.30-ish.
that they had initially forecasted. So that will have an impact, given the size of the Chinese economy, on global growth at large. We have to, you know, when we do our projections, when we look at the economy, we look at the global economy, and then we sort of narrow down and zoom on the European economy and the euro area in particular. But everything that happens in China, in the United States, in the UK, in Japan, in emerging market economies actually matter for us because we are strongly interrelated and have been trading with each other for a long time. And
Gonna hit target, it looks like. A few cents off, or a few ticks off, should I say.
And suffering for many is the fact that we are vastly dependent for the supply of rare
Target
earth
hit, if I was
and
long, I would
various
kind of be
metals
cutting out
that
now,
will
because
be
again, don't
critical
forget
for
this
the
release is
development
normally a
of the economy
fade.
of tomorrow,
So
if we
probably will
decide
start to pull back.
firmly go towards the green economy that we should be aiming for.
As an open economy, one of the things is just exactly as Christine says in terms of how we do our process. One of the things that we spend quite a bit of time on is world export prices. Now, actually, in the recovery from COVID, and of course this was the supply chain shock, we saw quite a big contribution to goods price inflation from world export prices. We're now seeing those prices definitely start to weaken. So that will be another determinant going forward of policy.
As central bankers, do you plan for the worst case scenarios on the geopolitical front? I mean, if China invades Taiwan, then what? What does a central banker do? Is there a contingency for that, Chair Powell?
We use our tools to achieve our legal mandates, if that happens.
Got that Fed speak down. You'll hold a special meeting. No, I mean, it's a volatile world we live in, right? And then
So
there's
we do
impacts.
have, in every FOMC cycle, we look at, our staff works up 6 or 7 or 8 alternative simulations, and they simulate, different things. It's not so much geopolitical events, though. It's more different ways the economy could play out. And we all the participants read those and think about them and talk about them, and they come up in our meetings, we talk about them. So it's very helpful because you can't get too focused on the modal path in a world where it's just very hard to predict the economy, even in
Norwegian Cruise Lines ticket NCLH as well, 52-week highs, coming into key level at 21.13.
I'm going to leave that to your imagination.
I bet I can think of a few. President Lagarde, Chair Powell did talk about, one of the things that I don't know that there was a simulation of is we had a few bank failures in the US this year. And I know it forced some of you into action to shore up banking systems. Are we in good shape now? Is the global and European financial system in good shape? Have we healed?
I can only speak to the banks over which we have supervision, and those are the euro area, the European banks. But I'm looking at the euro area specifically. We have been,
Like I said, the 68.30 was a target on the crude oil. Because we've hit that, again, not going to be something I touch. It's going to be a lot less accuracy if we try and trend this next break like we're getting right now. Again, this release is usually a fade, so if we continue, it's a lot harder to trade and the accuracy is a lot less, so I'm fully out.
The difficulties in Europe, and Europe does not include Switzerland, thank you very much. But we are extremely attentive. We reinforce the stress testing constantly. I'm very pleased to see that the Basel III agreement has now been reached, as I understand, between Parliament, the Council, and the Commission, so that we can actually roll out Basel III with as limited exception as possible. And we have to continue doing that job.
Any lessons that you took, Governor Bailey, from what happened earlier this year?
Well, let me start with a sort of bit of backdrop. I think it's important, drawing on what Christine was saying, I think it's important to, in a sense, reflect the fact that the regulatory changes we made after the global financial crisis have paid off, in the sense that we've been through, and we are going through, some huge economic shocks. And the banking system, certainly I can speak again as Christine does, I can speak for the UK banking system, is resilient to them, and is doing what we want it to do, which is support the economy, not the other way around, to be honest. Going back to the crisis.
By the way, as well, the straddles are picking up.
That's an important starting point.
And
Now,
so
I
is
think
the
there
market.
are,
So again,
important
with
lessons
increased
from
volatility, if we can break above VWAP on the straddles, usually shows you that we're going to be a bit more volatile for the day.
Christine made her subtle reference to Switzerland. Well, there's a huge sense of irony in the British, Christine. Look, there is obviously a question posed by the Credit Suisse, handling, which is, are the resolution plans for the major banks that we've spent the last 15 years developing fit for purpose, or are they not fit for purpose? And if, well, come on to that, if they're not fit for purpose, then of course we cannot sit here and say,
Unity
well,
looks like it's going to break its recent high, the 6-month high of 45.07. If so, looking at a short potential target
now, I'll give
at
you my view on it.
48.50.
I'm going to say this. I have not yet heard the case.
Could get a
made
small
to
one
me
as well at
which suggests
45.25,
they
but
are
that
not
would be
fit
less
for
likely to
purpose.
work
I
out.
state that. But I'm not going to leave it there. We have got to have, we've got to have
What you're looking at,
decide
Robinhood,
whether,
$42 price
one way or the
target.
other.
Let me turn this down so it's not too competing. And have a quick look at this. Hood I was looking at, I think we talked about it yesterday's stream. To me, it seems a lot more like a range stock. And I'll show you what I mean. So I'll quickly put off the speech off the screen and so we can run through this. But again, this left chart is a 6-month, the right is a 1 year. But especially on this 6 month, we can see very obvious range bound between these deviations. Looks like a potential break now. So what I would be looking at more, I wouldn't be looking for that overall strong move to $20 or $42 or $20, just because we are downtrending on the 6 month, we are downtrending on the 1 year. There is no massive change to their fundamentals to justify a massive move. So if it did, it would probably be some sort of a short squeeze. So if we did squeeze up to there, I would probably be looking to play against it. Robinhood is easy to borrow, does have options, means there's so many ways we can trade it. We could short the shares, buy the calls, so covered stock. We could be doing some sort of a vertical spread or just buying outright puts if we're looking to play against it, because that's what I'm personally looking to do. If we can hit from 1075 or above, to me those are short bias levels, so I'll be looking to trade from that level or above short bias, because again I don't really see it holding above this level, but that's at least my view on it.
Higher capital, those are all in place in the United States as well. So when it comes to the events we had earlier this year with 3 banks that had pretty idiosyncratic business models and funding models as well, I think we need to learn lessons, and we're not hiding from that at all. We understand there going to need to be regulatory strengthening of both regulatory and supervisory practices as it relates to institutions of that general size, I would say.
You got a lot of questions on that from Congress last week.
That's mostly what they wanted to talk about.
They want to make sure that you aren't, well, in part, not going to increase capital levels and sort of choke off the small and regional banks in this country and make it hard for them to compete.
So the U.S. has something like 4,500 banks. It's the most banks by a pretty big margin, I think, of any major economy. And we think it's a real benefit to have banks of different sizes and business models that serve local communities and offer different products, as well as having the large banks. And the large banks in the United States are very strong, well capitalized, a lot of liquidity. And they've been a source of strength, I think, through the last couple of events. So I think it's important that whatever changes we do make, keep in mind the need to preserve the business models of these of smaller banks and not just of the largest banks.
Any concerns for you, Governor Ueda, on the strength of the global financial system at this point, as we go through this, I don't know, once in several decades tightening period?
I can only talk about Japanese banks. Mm-hmm. I think they are well capitalized. They're capitalized. They have enough liquidity. It's true that some smaller banks, regional banks, are sitting on non-negligible amount of valuation losses on their security holdings. But on average, that's about 1% of their core loan capital. So it would be
yes, but straddles hitting VWAP, so we'll see if we can hold or hit and hold above. If so, again, probably going to trend on the SPY.
Because we go into the 2% inflation rate equilibrium in the sense I discussed earlier, then rates may go up by large margins. And we'll have to be careful. We'll have to be carrying out all sorts of stress tests, I think.
I also wanted to ask you, if you go into a more normalization stance away from negative rates and the yield curve control, how you'll manage the risk of the government's enormous financing needs, and whether that's a concern that you think about.
Well, we keep saying that's the business of the government and the diet to create sustainable government finance.
Fiscal policy in general, I'm curious if you guys will bite on this. Is it helpful right now or hurtful, President Lagarde?
You know, everybody has to do what everybody has to do. Man's got to do what a man's got to do. Monetary policy makers have to decide on monetary policy, and fiscal policymakers have to do their job. It is true that there are circumstances where working hand in hand and supporting each other has proved helpful. I think we had a very good demonstration this morning in one of the lectures that we had. I think what we have very clearly stated.
Okay, going to quickly run through a few things now, just because want to cover these before we did in the stream. We're going to go through everything that's happened in the speech, the key things to be paying attention to. First thing I want to note is, firstly, Norwegian Cruise Lines, just from a trading opportunity. We'll be posting it in the Discord. We're coming into $21.13. From here, very short bars on Norwegian Cruise Lines. First target going to be around $20, and if we can break that, $19.20. So looking at that short bias, again, we'll probably use this as a range. So what I'll probably do is short the shares by the calls, so I can buy within this range, and it doesn't matter if it does squeeze out, because again, there's always that possibility, but really looking to target down to here. And again, considering we have relatively bad earnings on Carnival Cruise Lines, that's why we sold off yesterday, we're already bouncing. Don't know how long this move is going to last, so again, looking to be short bias in that range. Now, on to the next thing then. Key things that were said within that speech. So we'll cover the ECB thing, so there's really three things in there. So firstly, they're not considering a rate pause at the moment. Still have ground to cover. If baseline stands, we'll likely hike. So basically, all the ECB, don't want to say confirmed, but near enough, a 99% chance, obviously coming into the next meeting, they're going to hike. So especially in the US, if we start to see them not having to hike while we're seeing Europe hike, don't forget this could be a play for the currencies, because we'll see the euro get stronger, the US dollar will get weaker against the euro if that continues to happen. But again, what was key was what Jerome Powell was saying is, where was it? I don't even know if I wrote it down here. Oh yeah, no, here. Wouldn't take moving at consecutive meetings off the table. So they're not saying, obviously, that they're not going to hike anymore. So if they do hike again, then the currency part may not be as important. But as soon as we start, because what will most likely happen is we will probably see the US stop to hike first. We've probably got one, maybe two max left hikes in the US. Europe and England, if we want to play the England, or the Bank of England and the pound plays as well, those will probably continue to hike much longer than the two that the US have. So again, we could be looking at these from a currency play. As soon as the US stops hiking, the other currencies, the pound and the euros, will get stronger because they're having to continue to hike. So that's one potential play. And then going over the other things, policy hasn't been restrictive for very long. We believe there's more restrictions coming, driven by the labour market. They did talk about then the rate hikes. Policy may not be restrictive enough, may not be restrictive for long enough, and then significant deflation in the pipeline for rents, but it will take time. And then lastly, we do not target particular parts of the market. Now this is key, because if they're saying this isn't what they do, it means if you see the bond market getting hammered, or if you see something like the real estate market getting hammered, again, they're not going to tailor the move to one or certain other product. So it means everything, or really they're just going to be looking at it as a broad market. And so it may mean, again, if you see the stock market get extremely overbought or extremely oversold, this may not impact what they choose to do at the next meeting. So those were the key things from that. And then we can quickly cover two stocks because their alerts just went off. So firstly, we have ACHR. So this one, we just draw the key levels today. We retested our second deviation 1 year support. We're now we're coming in to test our 6 month second deviation. There is definitely a chance we start to pull back. If so, target VWAP, then that deviation. Again, it is a small cap stock, but is easy to borrow, does have options, so multiple different ways we can play it. But again, this is a potential dead cat bounce. If we zoom out a tiny bit, go on to a 90-day, you can see it did do a mega move before. We're now getting a bit more of a move. So some people may be seeing that as a pullback. I'm personally seeing it a bit more as a dead cat bounce, because when we were at this value, we were extremely overbought. So seeing us start to pull back now, I would expect a move into either this 403 and that be the top, or retest up to 450 and then start to have quite a strong sell off. That would be what I'd be looking at on ACHR. If we push up, and that's why I've got the alert out, if we can push up to the 42 and the 54 level, I'm looking to take those short buys myself. And then we also had MVX go off. So again, this is one where we're short bias. We currently have our average at 1583. Again, we're short 200 shares. We got long the call. So even if it continues to go against us, our max loss on the trade coming into Friday close would be $65. So not the end of the world. We may potentially look to add a bit more size into this $17 level. If we come into this today, again, we're missing by 12 cents. We probably will hit it, because this is a high likelihood that we start to pull back. So I might look to trade that level as well, because then especially even if we do pull back nearer to our, well, what our current average is, again, those will be in the money by quite a strong amount. So that would be the key levels on there. And I think that was all the key alerts that have gone off today. Before we go, because we'll probably end this soon, if you guys got any stocks you want analysed, let me quickly see them now and we can go through them. Again, we were talking about crude oil. Crude oil is down here. This was the release. Inventories were stronger than expected, so we had our 2-day anchor VWAP target. That's what I paid attention to. It's where we took profits. We started to pull back. Again, I'm not paying attention to it anymore, because the likelihood or the continuation isn't going to be worth the risk to reward past this level, because again, this release is normally a fade. So there was a big difference today between the forecast and the actual, but not something I want to stay into, because again, I'm not as confident on continuing this uptrend. I was confident in the move to the VWAP or the anchored VWAP, but I wouldn't be as confident to continue this move. And even if it is, will probably be quite a small mover or slow mover. Other things we can cover, so CL Colgate alert went off today as well. We can quickly see what that is. Yeah, so if we do continue down, long bias coming into about $74.50. That's our 6 month first deviation. So definitely a potential long coming into that. We have XPOF. We opened up above, and let me actually zoom that back out. We opened, you can see we gapped up today. That's why we're up 20% today. We opened up, we retested our 6 month third deviation. We're holding that. So it could potentially move to our next resistance, which in this case would be $20.35. We then also have Nerve. So this was actually quite a nice trade. We traded this. Didn't play the resistance side. I didn't think it actually had the shares. Yeah, it's hard to borrow, so couldn't trade it short bias, but did come into our anchored and normal VWAP. So look to play the bounce. I took the profits coming into around there. Did end up squeezing further, failed that $10 level. So if we come to a retest this is really what I'm paying attention to, because waiting for that break. We do have resistances at 11.66 and 12.30, so that would be my key outlook on the stock if we can move to there. Again, looking at it short bias if we can, but it is hard to borrow, so it would just depend if I can get any shares available from the broker if we move it into that level. Then we also have meds. I'm not really paying attention to this anymore. The volatility's, gone super weak now, or the volume, sorry, has gone super weak now, so not something I'm paying attention to anymore. We covered the NCLH, we covered ACHR. I think that's everything else that has triggered today. EVMVH, we did cover that. Yeah, we did say if it comes in $17, looking to add into that short position. That would be the final add, because I don't think we have any more levels relatively close. Yeah, the next level after that is 1937. So if we did push to there, probably won't be this week, but I wouldn't be adding it in. I only ever do 3 adds. We well, we were meant to trade these levels, but kind of waited for it to break because it looked a bit more bullish on the day. So we got in a bit later around this level. So if we do continue, again, this would be my last average. I only average in 3 positions. So if we continued against that, I'll take my loss on Friday because those are the expirations I'm going to play to. Because again, it can make the play just relatively cheap. So that would be the key thing on there. And I think that would be basically everything. We also have snow. Want to be paying a bit of attention to this. We are currently testing our second deviations within this range. Really, what I'm paying more attention to is let me zoom this chart out. Is again, we tested this level more recently. We broke it. We pulled back. What I would be more waiting for now is a break of the previous high or the recent high. And then if so, we do actually have a target at 204, which I haven't actually put on the chart, but 204.90 is the current level. So if we break that, that's where I'd potentially be looking to place no short bias. CCL also breaking with Norwegian thing with Carnival Cruise Lines. Again, this and Norwegian will trade basically the same. I think, well, we've already had the earnings on CCL yesterday. But we do have earnings coming up on Norwegian Cruise Lines. When we do have the earnings come out on that, this will move Carnival Cruise Lines anyway. So we could either look to play the Carnival Cruise Lines or NCLH if we're looking to trade it. Not going to make too much difference. But again, we have broken our first deviation on the 1 year. We're coming in to test it on the 6 month. High probability short levels. But on a stock like this, I'm always a bit less happy to trade them because you're seeing the deviations move quite wide overnight. They'll tend to move by about 10-15 cents, which can mean if your short position doesn't work out quite quick, can kind of turn into a loser. So be one of those things. I might not trade this at all. The NCLH is what I'm actually preferring the setup on, just because the chart's a bit more flat on the 6 month. So again, coming into this range, potential short bias, but nothing we have to actually trade. But definitely something I want to be paying attention to. Again, we'll be down to earnings. Actually, they've already had their earnings this quarter, so yeah, probably be something I'll wait for and see probably what the overall market is doing and look to follow it that way. And I don't think there's really any other stocks we have to cover. We covered Unity, didn't we? So ticker U. I think we already looked over that earlier in the stream. Same thing though, as it comes into 45.60, definitely looking to play the short bias. That will be small size because we have basically already hit that level. The one I'm taking big size at will be the 48.50 level. So that's what I'm paying attention to on Unity. Then we have Kellogg's, don't want to be touching that. I don't think anything else was too near key levels. Home Depot is kind of coming into relatively strong levels, but again, the volume isn't usually there, especially on the options for me to kind of justify trading it. So probably won't be something I trade unless you're looking to trade the outright shares. So I think that will be about everything anyway that I'm paying attention to for today. Again, probably going to end the stream here because we're coming into 11 o'clock. The speech is still on, but again, I think anything big will usually happen near the beginning. But again, considering as well it's to do with the ECB conference, not so much a direct speech. You're not going to see a massive impact on the market anyway. So yeah, I mean, there's no need to really watch all of it. Just wanted to kind of catch the beginning while we were trading. But that's what I'm watching for as well. One last thing then, ENVX has broken or hit its $17 level. So again, potentially looking to add to the short position. Because again, we're still not even down massively on the option side of the trade. Actually, I can even show it to you. So what you can see here again, what we do is we buy the short the shares, we buy the calls. So what you can see here is even though the shares shorted are actually down $120, obviously the 2 calls offset that loss. So really we're only actually right down now, down $18 on the stock. Reason I like trading this is if it goes against you, you don't really lose too much money. If it goes your way, you can make money and you can actually manage the trade in a way to make a lot more money. So that's what I'm watching for. Again, if we get the direction wrong, that's part of trading. Nothing we can do about that. But we'll probably look to trade this $17 level. A bit more short bias again, Friday expirations, but I'll probably look to enter a bit later in the day because if we can continue to trend, we will probably trend through that level. But we are already putting back on it. So again, it will just be something we watch. I'd rather get a bit of a delayed entry, considering this will be my last entry. So if we have to get it a bit lower down, that's fine, but it means if we break, we don't have to enter right away. So that is it for the stream today. Again, we'll be back tomorrow. We're streaming 5 minutes before the market opens to usually about 11 o'clock market time. So I hope to see you there. And that's it. Peace.